Silver just had its worst week since the crash of March 2020. The price dropped from $90 to $71 in less than 7 trading days. And right now, every mainstream financial outlet is telling you the same story. Central banks might hike rates. Precious metals don't like that. End of story. But here is what they are not telling you. The liquidations driving this crash started at midnight Eastern Time, every single night, in Asia. And that is not a central bank rate story. That is something entirely different. Something older and deeper in the financial system. And something that, once you understand it, completely changes how you see what is happening to your silver stack right now. I want to be honest with you from the start of this video, because what I am about to walk you through is not comfortable. It is not a simple buy the dip message. It is a framework. And once you have this framework in your head, you will never look at a precious metals crash the same way again. Subscribe right now if you have not already, because what I am going to show you is not appearing on any mainstream financial channel. They do not have the vocabulary for it. We do. Let us get into it. Here is the controversy I need to put on the table immediately, and I want you to sit with the discomfort of this for a moment. Silver holders have been more right than wrong. The structural case for silver supply deficits for 5 consecutive years, global shortfall for 2026 approaching 200 million ounces, according to the Silver Institute. COMEX registered inventory declining 31% in a matter of months to 86 million ounces. None of that has changed. None of it. Silver touched $121.62 per ounce just weeks ago. That is a 135% gain in a single year. The thesis was working, and yet here we sit, staring at $71.62 on the screen. So the real question is not whether the silver story is broken. The real question is, what kind of crash is this? And what mechanism is driving it? Because once you understand the mechanism, you can stop being scared and start being strategic. And I want to plant something in your mind right now that I'm going to come back to at the end of this video. The mechanism behind this crash is not the mechanism that ends bull markets. It is the mechanism that creates the most violent, most explosive recoveries. Stay with me. Let us talk about the dollar, not the dollar you think about when you check your bank account. The other dollar, the one that runs the world. Most people think of the US dollar as something that reflects American government policy. Print more money, dollar goes down. Raise rates, dollar goes up. That is roughly 20% of the actual story. The dollar that controls commodity prices globally is the eurodollar, not the euro currency. The eurodollar. It is the offshore dollar system, the network of dollar-denominated credit that exists entirely outside the United States, created by global banks, sitting in London and Tokyo and Singapore and Frankfurt. It is the world's true reserve currency because it meets the 2 requirements every reserve currency must meet. It is available everywhere and it is accepted everywhere. And right now, that system is seizing up. Think about what that means in practical terms. If you are an import firm in Jakarta trying to buy liquefied natural gas that was supposed to come through the Strait of Hormuz, but now cannot, you need dollars. Fast. You did not plan for this. You did not budget for this emergency draw on credit lines. You go to the global banking system, which is itself sitting in the most risk-averse posture it has been in years, and you are told the cost of borrowing those dollars just went up significantly. You and every other import firm in Asia and Europe having the exact same conversation at the exact same time. That is what economists call a surge in eurodollar demand. And here is the brutal part. When demand surges and supply does not follow, price goes up. In currency terms, the dollar's exchange value goes up. And what happens to everything priced in dollars when the dollar itself gets more expensive? It gets sold aggressively. And what gets sold first? The things that are liquid, that can be turned into dollars fastest, commodities, including silver and gold. Now I want to go deeper than the exchange rate, because this is where most analysis stops and where real analysis begins. Bloomberg reported something on March 3rd that almost nobody paid attention to, a measure called the cross-currency basis, which tracks the extra cost of sourcing dollars overseas versus domestically, was showing a surge in demand for the US dollar relative to the Swiss franc, the euro, and the British pound. The analysts involved described what they were seeing as, quote, a deterioration in risk sentiment, increasing credit spreads, and spurring a rise in precautionary demand for dollar funding, end quote. Two things happening simultaneously. One, the oil shock from the Iran conflict creating emergency dollar demand from energy importers across Asia. Two, flight to safety demand as investors globally tried to move out of riskier positions and into dollar assets. That is a compression, both sides of the equation tightening at once. More people needing dollars. Fewer people willing to lend them. Now, here is where it gets technical, but please stay with me because this is the part that explains why the damage was so much worse than anyone expected. There is a new academic paper published in late January 2026 titled "The Dollar's Double Life. Not all dollar appreciations are born equal for the cross-currency basis." And what it shows is that before this recent tightening, the dollar was in what researchers call a low dollar regime. The currency had been relatively stable or softening. The paper found that in low dollar regimes, when a shock hits and suddenly pushes the dollar higher, the response in global funding markets is dramatically amplified compared to what you would see if the dollar were already elevated. They called it an amplifier effect. The system essentially overreacts, which explains why gold dropped almost 9% in a single week, which explains why silver dropped more than 10% in the same period, which explains why aluminum on the London Metal Exchange had its worst single day since 2018. These were not ordinary down days. The mathematics of how the global dollar system responds to shock in a low dollar regime were essentially working against every commodity at once. Let me say that again so it sinks in. This was not selling. This was forced liquidation under amplified dollar stress. In a monetary regime where the system itself was structurally set up to overreact. And the data in the precious metals market confirms this interpretation completely. Look at the timing pattern. Gold's worst day in the week that just passed started selling just after midnight Eastern time and continued until 8 a.m. That is an Asian market liquidation window. Silver's single worst intraday move was 12% down in that same morning window on Thursday. These are not American institutional investors executing strategy. These are leveraged participants globally converting assets to dollars under duress. They are not selling because they no longer believe in silver. They are selling because they need dollars. Now, and here is the critical data point I need you to understand before we talk about what comes next. COMEX registered silver, the physical metal available for immediate delivery, the metal that backs the paper contracts, stood at approximately 86 million ounces at the end of February, according to COMEX warehouse reports, after a 31% decline from levels seen just months prior. The paper to physical leverage ratio inside that system sits at 7-1, 7 paper claims for every 1 ounce of real metal, and the coverage ratio, the percentage of outstanding paper contracts that registered inventory could actually service, is at 14%. Below 15% is historically considered stress territory. Let me be clear about what that means. The physical supply squeeze that drove silver to $121 in January has not been resolved by this crash. The COMEX delivery stress in March, the first notice day demands representing more than 60% of available registered inventory. None of that structural pressure has gone away. If anything, the forced liquidations of the past week have separated the paper market even further from the physical reality underneath it. Weak hands have been cleared. Strong hands remain. This is not financial advice, and I want to be direct with you. Every individual must assess their own risk tolerance and investment objectives. My job is to show you the data and give you the framework. What you do with it is yours. But here is the analytical conclusion that I believe the data supports, and it is based on historical pattern matching across every major deflationary dollar shock of the last 3 decades. What we are watching right now looks structurally like March of 2020. It looks like October of 2008. In both cases, commodities, including precious metals, were liquidated violently and rapidly as the eurodollar system seized. In both cases, the bottoms were fast and not obvious until after the fact. In both cases, the assets that were liquidated, not because of lost confidence, but because of forced dollar demand, recovered with extraordinary speed once the funding pressure eased. March 2020 saw gold reclaim all losses and set new all-time highs within 60 days. Silver's recovery from the 2020 crash was 140% in 12 months. The difference between those who captured that move and those who did not? Understanding the mechanism. The mechanism here is a dollar squeeze. Dollar squeezes end. And when this one ends, the structural case that was already in place before it started, 5 years of supply deficits, 86 million ounces of COMEX inventory against 7-to-1 paper leverage, China's export controls still in place, silver on the US critical minerals list, industrial demand running above 1 billion ounces per year against annual mine production of only around 830 million. All of that does not disappear, it waits. Based on the historical pattern and the structural data I have laid out in this video, my analysis suggests that we are watching a forced liquidation event, not a thesis reversal. The timeline for resolution is not a matter of years. It is a matter of weeks to months, depending on how quickly the dollar funding pressure normalizes. If you have found this framework useful, drop a like. It helps more people find this analysis when they need it most. Share this with one person in your life who is watching their stack bleed and does not understand why. There are 3 types of people watching this video right now. The first type is scared. They are looking at $71 on the screen and wondering if they made a mistake. The second type is confused. They believed the silver thesis. They believed the COMEX data, and nothing about this week made sense until this moment. And the third type understands what they just watched. They see the mechanism. They see the dollar squeeze. They see the structural data underneath the price that has not moved. They are not comfortable, but they are not panicking either. They are watching. Which type are you? Let me know in the comments and tell me your honest silver price target for this cycle. Drop it below. I read every single one. If this is the first time you have found this channel, subscribe and hit the notification bell. Every time I publish a data-driven breakdown like this, you will be the first to know. This is not the end of the silver story. Based on my analysis, this may be the last discount it gives you before the next leg up begins.